Let's talk about alignment.
Let's do it. Our favorite pure play managed care stock on the market at the moment.
There's really no good comps besides Humana, which isn't really pure play because they have the weird Medicaid business and CenterWell.
Yeah, I mean maybe Clover, but even Clover, I mean Clover pivoted itself to be a provider enablement platform, right? And like they sold off all their uh they outsourced their MA capabilities. So like but their business is still an MA plan. But yeah, I
Yeah.
mean alignment at this point in the industry is kind of a little thing unto itself in the MA world. You've got private companies it's similar to, right? But
Yeah.
um, it's an interesting play.
Yeah. So how was their quarter this past quarter?
Similar to every other quarter recently, it was good, right? I They beat and raised again. Um, they continuing to execute really solidly in a very tumultuous broader MA market, and that was kind of the theme of their commentary, right? It was like uh, in the midst of all of this chaos, they're kind of ho-hum moving along. I really like you wrote a funny analogy. Uh, uh, remind Walk through for folks what the analogy you used was.
Oh, well, so I'm a big college football fan, specifically a big Big Ten college football fan, which historically the like joke about Big Ten football is that it was, they give the ball to the running back and try to run up the middle. And
Yeah,
so there's
big
a
offensive linemen from farm towns in Iowa and Wisconsin and whatnot running the football.
yeah,
Yeah.
corn-fed. And so the coach Woody Hayes described the strategy as 3 yards in a cloud of dust. You just run the ball, run the ball, run the ball. Really a big focus on the fundamentals. And that to me is alignment. Like there is nothing. They get on their earnings call and the news is great. And they
Mhm.
like make gestures towards AI stuff. But like what they're doing is like they're running the insurance equivalent of the run up the middle offense with a bunch of corn-fed linemen, and it's working really well for them. I thought your call out in your commentary and when we were chatting on the analysts being like, "Are you guys sandbagging us a little bit on guidelines?" was funny because probably the answer is yes, but also they are a dispositionally conservative company.
Yeah, I there was the analyst question was, guys, this is the fourth time you've raised guidance this calendar year. Like, I appreciate that you're conservative, but like, are you being too conservative here? And I mean, the CFO's answer was, well, it's been a wild year for the industry. We didn't know how a lot of this is going to play out, and yeah, we're executing really well. So I mean, I appreciate that answer. It's nice to see a company just like executing on its core play, as you're saying, when the rest of the industry is doing so much other stuff. Like they've carved out this, hey, this is what we're doing. It's pretty straightforward. We're the only company in the space focused on care management like we are, and that's given us a competitive advantage. And it's like it's a really compelling value prop today, right? Like I can't argue with that. But yeah, it is funny hearing the analysts go. So like are you sandbagging us? You know?
What's the real
Yeah.
guidance? Give us the real
Yeah.
guidance.
Right. Which to me is kind of it's interesting hearing the tone of this earnings call, particularly this season versus everybody else, where for everybody else, it's like we're getting back to the core, right? United, my commentary there was it's back to the basics. Aetna is like, hey, we are like building the solid foundation to grow upon in the future. And every question, conversation is about like, what are you doing today to make sure the core business is okay? And alignments, the whole Q&A, it's not about the core business today. It's about how do you make sure that what you are doing today so well stays intact as you grow, right? Which I think is just a really interesting and good spot to be for a company of their stature. Like, despite the fact that they are a public company, they've only got 230,000 MA members, which, like I say, only that's not like a small amount of MA membership. That's for compared to some of the startups that have tried to enter the MA space over the past few years. Like they've done really well in growing to 230,000 Medicare Advantage lives. But the play for public market investors is like, can this thing grow to be the next Humana? Like that is how alignment actually wins in the public markets over time, right? Is like they displace one of these core kind of top three players in the MMA market and they become one themselves. And that's I can almost like feel that question from analysts of like, okay, so this is working really well. You've expanded from California, which is your core market. You've got your Nevada and North Carolina plans, which they're trumpeting as five-star plans, which is awesome. Alignment is 100% of their membership is in four-star plans, which is also awesome. Like those are incredibly good results. But the question then nonetheless persists of like, can they continue doing that over time as they scale up from 200,000 members to millions of members? And what does that look like?
Yeah, I think United Healthcare has 10 million MA
Mhm.
members this year, and Humana is maybe 6 or 7.
That sounds right-ish. Yeah.
And then, yeah, this is 230,000.
Yeah.
Um, the total number of lives that United Healthcare is shedding next year is 4 times alignments,
Right.
more than 4 times alignments total enrollment. So yeah, they're small. And one of the things you and I talk about when we talk about alignment is how much of this is, them being a really good, solid, fundamental, in their lane, and how much of
Mhm.
this is that there are a lot of returns to scale for insurance companies, but doing
Yep.
care management, there are some diseconomies of scale.
Mhm.
Again, I think it's too early to answer those questions, but talking about this quarter, right? Membership's up, revenue's up, medical benefits ratio improved 120 basis points year over year and was better than any of the other MLRs we've heard from companies, with the exception of Cigna, and that's
Yep.
not a comp because that's mostly group. Um, my favorite though is the SG&A ratio for alignment. 9.6%, 120 basis point improvement year over year. Their growing membership and their SG&A ratio is going down, and they keep on saying it's going to keep going down.
Yep. It's impressive, right? I mean, it to your point, we've talked about this before. I think it conceptually, and we've not been inside of alignment, so I don't know what it's actually like inside the organization, but just like as a matter of theory, I can very much see the narrative playing out of, hey, you've got these big incumbent, you've got United, Humana, et cetera. They've grown via acquisitions. They've kind of had to Frankenstein these platforms on the back end of their organizations. While you've got alignment, which because it's been relatively small and newer, it's been able to build its platform ground up, purpose built around this kind of singular use case, if you will. And because of that, they're able to operate the business more efficiently. They don't need as many call center staff. They don't need as much back office type spending, and that allows them to manage SG&A better. It also allows them at the same time, kind of paradoxically, to manage medical better because it's kind of purpose built for that and doesn't have the legacy drag of trying to stitch together these various platforms and like all that kind of nonsense. Conceptually, that makes sense to me that that theory would hold and that you would see improvement from that. I don't
Yeah,
know.
I buy it, and my
Mhm.
question, your question, I think the analyst questions is like, at what point do the laws of gravity start applying again?
Yeah.
I
I'd be
don't think it's
curious your
gonna.
take
Yeah,
on I'd be curious your take on their answer to the like one of the analysts asked the question about M&A moving forward and kind of the like the question behind the question was the concern that we just talked about of what happens if you screw up the platform. I'd be curious your take on their answer to that and how they're thinking about M&A.
I thought that was a good example of where alignment's head at, is because they were like, don't worry, we're not going to go out and buy books of business. Like, if you're worried about that, please don't worry. They'd mentioned M&A at they were at some investor conference, and they had mentioned M&A. Yeah, they're thinking about M&A in terms of supplemental benefits, right? And it was interesting. One analyst asked about their that their supplemental benefits are a little bit less rich than a lot of their competitors, and was asking, okay, like what's going on with that? And it ties to their M&A question. It's like one thing that if you are not a large scaled health plan is you can only offer less generous supplemental benefits, and if you don't kind of own your own, you're paying a third party vendor to do that. So what they're
Mhm.
saying is we can just tuck in these supplemental benefits. Maybe it's dental, maybe it's a behavioral health benefit, and we think we can do that without sacrificing performance. And that makes a lot more sense to me than going out and trying to buy a bunch of business. Something you've talked about before. We both love the healthscape um, chart that talks about all of these plans that are probably going to go out of business. There will be a
Mhm.
lot of tempting opportunities to grow really quickly in MA markets.
Yep.
Um,
Yep.
and
It'll be interesting to watch how alignment addresses that over time because you can see so they gave the update on 2026 AEP, right? Which is, hey, we're doing really well. Retention is really high. New membership is really high. We've got a lot of growth. Like 85% of growth is from people switching plans. We'll grow 20% year over year. 20% year over year on 240,000 members is still what? 40,000 members. So they're going to 260,000 members. Like you can see a world in which, 2027, an analyst was asking them about that, and they were talking about entering new markets in that 2027 period, both in existing states, new markets, but also entering into new states. And if you're a Wall Street analyst and you're going, hey, like this thing is a gravy train, it's doing great, it's generating profits in Medicare Advantage, you need to grow faster now. Like that is your next go get, like to keep your multiple so high. You need to get from not from 220,000 lives to 260,000 lives next year. You need to get from 220,000 to 500,000 to a million. How do you do that? You do like all of a sudden those tuck-in acquisitions, not just of supplemental benefits, but buying lives starts to look really, really attractive. And I, to me, that's going to be the most interesting question to watch as they continue to grow over time. Like how much can they avoid that temptation of being pushed by the market to continue growth if the underlying narrative is really true, which is so as they were talking about that 2026 AEP, one of the comments John Cowell, their CEO, proactively brought up was he's like, I know there's the concern among investors that as we grow, it's going to hit our profitability because that's what's happened time and again in the space over the last few years, right? These plans get sizable membership growth and then profitability sinks. It happened to CVS in 2024. United then took that membership, or maybe not, but United had that experience more recently. So the analysts are sitting there going, hey, alignment, if you grow, are you going to have that same issue? And his response is, well, we grew 60% in, what was it, 24? And we didn't have that issue. We managed that very well. It was just fine. We're going to be fine going forward. Okay, so if that's true, why couldn't you just buy lives from another plan and continue doing that, right? Like that should probably hold. We'll see.
we will see. I'm curious to hear. I'd never heard this term before, but de-delegation and how they're kind of thinking about their care management and utilization management strategies. I'm curious for your reactions on that.
I so let's go high level for a second, then come back into that specific question. So high level, this kind of comes up in their how they think about managing risk and how they are performing so well, right? So they talk about their admits per thousand being in the low 140s, I think was the number they cited, which they use as a proof point that they're doing really well. And that does seem like a really good proof point. We were looking at data from Oak Street that they're at like 171 admits per K. And I think they were saying industry norm is, what was it, 300 in that data source, right? Which seems
Yeah,
high. So who knows, but it seems like they're doing well. I think it's the takeaway, right? They were talking about I think they said, what was it? 65% of their membership base is in what they were calling shared risk relationships. The other 30% is in global cap relationships today. They think that 30% is going to migrate into shared risk, which they think is the longer term kind of they called it more durable with less abrasion between the plan and the provider, which makes sense given what's going on in global cap space. But a big part of what they're doing, so the way Cow described what they're doing in that shared risk space is that alignment takes risk on inpatient, and they delegate the risk for everything else goes to the IPAs. Maybe not everything else, but um, IPAs take risk on non-inpatient, alignment takes risk on inpatient. And alignment has what they've been talking about, what they were talking about in the earnings call was that they've de-delegated utilization management from those IPAs where alignment is taking risk for inpatient and they are doing utilization management around that. And they describe that approach as win-win. That is good for both the providers and the payer. And you mentioned you saw that they're hiring hospitalists, which makes sense in this context of, okay, so what they're doing is they've got these primary care groups. It's probably a pain in the butt for these primary care groups to manage care inside the hospital. Alignment is going to them saying, hey, we can bring in a hospitalist who can do that for you and is going to coordinate care with you. So you're going to hear that this patient's in the hospital. They can follow up with you. Isn't that going to be great? I'm guessing that's what they're doing and de-delegating UM and taking that back in-house and managing that themselves. And it was interesting to hear too how they think about it differently in their different markets. So California is a relatively unique market where alignment is working with the IPAs that have been there forever and are already doing that. The other markets it's entering, it mentioned that it is essentially becoming the IPA. So it is bringing together all the local primary care groups and then managing them as the IPA itself versus contracting with the IPA, which will just be an interesting kind of strategy for them to watch over time. And like they call this dedelegation a win-win. And I'm curious to see how that plays out over time. Like you can imagine a world where if costs run too hot or something like that, and you've got these hospitalists, like eventually there's going to be a friction point there between the plan and the payer, right? I would think.
Yeah. I also think it's interesting to hear a health plan talking about their use of IPAs and obviously, Alignment Health isn't a medical group. They employ their own physicians to do some of this stuff, but we heard Optum Health talking a little bit about trimming their IPA utilization because it's really hard to manage IPAs because they're independent physicians.
Right.
And this is another one of those things where as much as I like the alignment story, I'm cognizant that the stuff doesn't scale. That at a certain
Mhm.
point, if your network of IPAs is too big, it's very hard to keep the kind of quality management, utilization management that's keeping your medical loss ratios low.
For sure. Yep. And that's going to be the question, right?
I thought it was interesting. Everyone is like, okay, we got 1 year left of V28, and it's like, physically painful for everyone in the space. And then an analyst is like, what do you think V29 is gonna look like?
Uh-huh. Yeah. Again,
It's like,
back to the general like alignment is in this really unique spot. Everybody's like, okay, they're doing like Alignment's already managing V28. I don't care what they're doing to mitigate all of the issues in the last year of the phase and whatnot. Like, they're the one company that has this under control. I don't need to ask them about, like, are they screwed because of the last year of V28? Instead, I'm curious, like, what do they think is going to be next? Because, there was V24 before V28. I do not understand the nomenclature at all. So, like, is it going to be V29? Is it going to be something else? I don't know. That's for somebody else to figure out. But yeah, I thought I I think it's interesting like the different set of questions they get asked because of how well they are doing at the moment. I'm curious, what was your take on the V29 commentary? How did you process all that?
yeah, it was right in line with what I heard from Georgetown's Medicare policy initiative folks. They're like, health risk assessments and chart reviews are um, going to come under a lot more scrutiny. And the line that you're hearing from people on the Hill and the policy wongs at the think tanks is that, Medicare Advantage and risk adjustment should be for things that have clinical work attached to them. And so it can't just be something that is like you sort of data mine in a chart.
Hmm. I
That's
wouldn't think
great.
anybody will disagree. Like uh, that doesn't seem like it'll foster that much disagreement. It might foster some painful changes in the industry, but I can't imagine anybody sitting there really arguing that point, right?
Yeah, I think that, I don't want to like I don't want to be the defender of risk adjustment here, but whenever you make the programs more complicated, like
Hmm.
we're giving up something by doing that, and it means more administrative costs, right? Like if you
Yep.
need to now base it all on something that's coming from an actual clinical encounter, then rather than just being able to like look at a chart and have an somewhat objective call on what's in the chart versus not in the chart and have that be auditable. Now we're saying, well, you know, they have diabetic retinopathy, and does it count that I gave them a referral for this, but the referral never, like, they never followed up on it? Like, we, anything more, like, the more complexity we add to the system, we're adding more administrative costs. And
Hmm.
I mean, the sort of status quo means that like you can kind of adjust to both the ways to game the system and then also think about ways to mitigate those gamings of the system.
Yep, that makes sense.
Scrapping everything off the table and starting over again with a new system means there'll be a similar lag where the companies will spend a few years eating really well off the new um, the large companies specifically will spend a few
Mhm.
years eating really well off of the new complexity, and then
Yep.
we'll need to do V30.
It's one of the interesting, obviously, there's a lot of questions right now about for-profit and healthcare and whatnot at the moment. But I actually just philosophically don't think I mind the fact that, okay, the government sets the rules of the program, and then you have private enterprises under like seeking to understand those rules and operating within them to make profit while they are also trying to deliver good quality care for patients, but they are trying to sustain themselves and grow enterprises that presumably are delivering good quality care. Like the program seemed to get awry in the past few years because there are all these questions of you were incentivizing behaviors that seem to have nothing to do with good quality care. And I think there's a debate over how much that happened, but like that seems to be the core fundamental argument, right? But like if the government could just set some like rules in place that aligned and incentivized the behaviors that we want, that seems like a net good thing to me. Like it seems like a shame that, the progress that the Oak Streets, the Ioras made in driving the growth of advanced primary care models. And like Oak Street, we just saw them in the news the other day. When they were acquired, they had 200 clinics. They were supposed to go to 300. Now CVS is having to hold it flat because the profit margin associated with V28 has eroded this global cap model, right? And to me, it's like, I sometimes wonder if we end up throwing out the baby with the bathwater with this type of stuff of like, maybe we should be paying a little bit more for primary care, even if it is part of risk adjustment and them doing well if they're taking care of sicker populations and doing that better. Maybe that's not such a bad thing on the whole. So hopefully, in my mind, I don't know where I'm going with that. I'm gonna get off my
Yeah.
rant. But like, I hopefully the risk adjustment changes that are coming down the pipe because it clearly seems like they are coming down the pipe actually support incentivizing the behaviors that I think collectively we all want to see, right? That seems like the goal.
Yeah. I really feel strongly that like you should expect the profit-seeking entities to profit maximize, and you as the government should make better rules and
For
really
sure.
think it through. And some of this comes down to like they should hire some X, like the government should hire some X corporate strategy and rev optimization folks from the plans and say like if we did this how would you attack this problem, what's the surface area, how could this be gained, because the outcome we're looking for is more dollars going to primary care.
Hmm.
Personally.
Yep.
That's what I want.
Yep.
So to kind of put a bow on this, I think that two questions you and I like to go back to a lot are, is health insurance an investable business? And, all of these smaller plans have negative operating margins. So that second question is there a place for the non-BUCA plans or just scale kind of beat strategy in this space? And I'm curious to hear whether this has revised your thoughts on those questions at all.
I mean, I think it would be glib to not say that alignment is not doing both of those things, right? Like they clearly are an investable asset at the moment, given how they're performing, and they are showing that a regional plan can do these things. I so it does seem possible that the answer to those questions are yes. I think the question in many ways is okay, alignment is proving that it can be done. Can others do it too? For question number two, right? Given all of the issues we've seen with other regional health plans and the financial challenges that they're having, like alignment is kind of a neat little unicorn in the space at the moment. And I'm not sure that other plans will be able to snap their fingers and go, oh, we're going to do what alignment's doing now. And that's the issue. Alignment's on a path unto itself. Um, so that's kind of how I view that. And then on one, it's gonna the question is kind of on what time horizon are you viewing investability for alignment? Like it very much seems like they have a clear runway the next few years to continue driving solid 20% growth and profitability, and that's going to be a good business to be in. Um, I think the question for investors is how quickly you can try to scale it and like can you actually do that and maintain the margins of the good business, right? Like the problem, I guess, to wrap up this thought, the challenge with the investability of health plans is not that you can't have periods of profitability. It is that it is hard to sustain that over time as markets react and change to the profitability of those plans. So, like every market has 3-year profitability cycles where plans do really well, but then profits compress and you have a 3-year period where those plans go underwater and disappear. And that's what's happening to the rest of the market today. And so alignment doing well today is great. The question is how far into the future can they sustain that indefinitely and how quickly can they grow? And I don't know. How about you? What do you think?
Yeah, I think that it's going to be interesting to hear how alignment reacts when they start getting that pressure from investors to grow more quickly than they want to. And I think we'll know pretty quickly what the market sentiment is and where the board of directors heads are at if we start seeing them break some of the rules that they've laid down, which are, we're going to finance growth through cash flow, operating cash flow. We're going to not buy books of business and grow organically. And so
Yep.
that's what I'll be watching for.
Yep.
But for right now, I want to believe.
Yep, for sure. I mean, 2026, I think is good. Like it's setting up to be a good year for them, it seems. I think the interesting questions will start to come in 2027 and beyond when it's like, okay, you guys are doing great. How quickly you can grow this thing, to your point. So
Yeah,
it'll be fun to watch.
it'd be fun to watch. Let's leave it there.
Cool. See you, Martin.
See ya, Kevin.